Good afternoon, good evening, good morning, wherever you are in the world, watching this, our latest webinar, focusing on cross-border taxation and working remotely, predominantly aimed at those in South Africa, but potentially further afield. So you might be working for a remote company or a digital nomad. For those that don't know me, I'm Mark McAllister. I'm the senior partner for Holborn, based here in Cape Town. Feel free to connect with me on any of the social media channels below. Likewise, if you want to drop me a WhatsApp, just scan this QR code and you can simply drop a message via that channel. There's a Q&A button at the bottom of the screen. So if there's any particular questions that you want to ask along the way, don't hesitate to do so. You can do that using the Q&A button at the bottom if you're on Zoom. If you're following us on Facebook Live, then ask the question in the comments or drop us a WhatsApp. I'll do my best to try and answer it along the way. Just to be clear, I'm not a tax consultant. I'm a cross-border financial advisor. I'm not able to go into specific cases. So if I feel like we're straying into that sort of line of advice, then unfortunately I won't be able to answer the question specifically. I'll do my best around general principles. And obviously we deal with sort of situations on a regular basis and able to answer a lot of those questions in general terms. So who are we? Well, Holborn have been around for 25 years now. So we've got about $3 billion in management and administration for clients in over 30 countries, from a lot of offices in over 11, over a couple of thousand happy reviews on Trustpilot. So feel free to check us out. Who are our typical clients? Well, the globally mobile is probably the best way of describing it. So if you are moving between countries like the UK, like South Africa, back and forth, or Europe or America, and you're looking for somebody that knows how to manage assets between borders and without things like grey listing getting in the way, then that's where we come in, and we've been doing that for, like I say, 25 years now. Okay, so who is this webinar for? So a few questions here that might resonate with you. So are you currently abroad, but you're thinking about coming back to South Africa sometime soon? And when you do come back, do you plan on working for your employer remotely when you get back here? Are you not sure if you can still be employed or not? And will this involve some kind of subcontracting or self-employed arrangement? Do you want to know about how to protect foreign earnings and legally mitigate taxation? And are you aware of what legislation you should be thinking about? So if any of those questions sort of sound like something you're thinking about, then we'll try and do our best to go through some general terms on that shortly. So here are the questions we often get asked. So what is a dual tax agreement? What does it mean? How do I live in South Africa and work remotely? So, maybe as a digital nomad or a digital remote worker down here. Who do I pay tax to? How does that work? What are the implications for my employer? That's one we often get asked as well. And should I incorporate or become a contractor? And if so, in what country? Again, a lot of points to that. And one of the solutions becoming more and more popular in this space, what is a foreign agency? How does that work? And then linked with all of that, it's great that we've got foreign income for obvious reasons. People that are outside of the country want to carry on earning pounds, dollars, euros, etc. But how do you do the responsible thing and plan for your future so you and your family are secure with that income stream? And that's, again, something that we will try and cover as we go along. So let's break it down. First things first, what is a dual tax agreement? Well, in essence, what they mean is that you shouldn't pay tax twice, okay? It doesn't mean that you shouldn't pay any tax at all. Thankfully, this is quite a rare discussion, but I do still have people that feel that they can swerve the tax man, hide away, he's never going to find out. Ultimately, you almost certainly still owe a government for your tax, depending on who you are, where you are in the world, and how long you've been there. So the question is obviously, which side of the line are you? This is very, very relevant as well now that the UK are moving towards a residency-based tax system. So previously it was a principal-based tax system about domicility. So it has made things a little bit easier to understand than historically. But again, you need to understand the onus is on you to know where you are. One thing linked with this, again, I'd encourage you to Google this if you are thinking to yourself, yeah, need to not worry about that, is common reporting standards. be under no illusion that the governments of the day share data linked to things like your passport number, driving license, and what have you. So if you've got a bank account set in the UK that you've been using for years whilst you've been down here thinking nobody's going to spot it, unfortunately, that simply is not the case. Recently had a discussion with a client that's been doing exactly this. And my advice to them has been, as I would to anyone, you have to make sure you report your income to the relevant authorities. And if you're a South African tax resident, that could be SARS, not HMRC. So it's important to understand where you sit between the two. One thing I will talk about, though, that's not all bad news, doom and gloom. For those that aren't aware, one of the things I spend a lot of time doing is making sure we make your pension income as tax efficient as possible. And South Africa is one of the most tax efficient jurisdictions in the world to retire to, particularly if you've got foreign pension vehicles. And so quite often what we do is structure those in a more effective way, get them really growing for you, but also so that when you draw on them in South Africa in the future, you can do so free of any income tax. So it's a subject we discuss at plenty of other webinars. If you want to learn more about that specifically, we'll touch on it a little bit, but tune into my Getting Financially Fit to Return webinars. It's one of the biggest plus points coming back to South Africa from a financial planning perspective. Okay, so how do I live in South Africa and work remotely for an overseas employer? Well, first things first, let's talk about the physicality of it. Easily, COVID taught us a lot of things along the journey, one of which was that actually you don't have to be tied physically to an office, like we used to. So we saw the rise of Zoom. We're on Zoom here at the moment, Teams and other remote working apps. So it's very easy now to have employment streams outside of South Africa doing roles that are remotely based. One of the things I always encourage all my clients to do, particularly if you're contracting or doing anything like this, is run your life like a business. Okay, very, very important principles here. So what do I mean by that? A business has a revenue stream, and if you want to be more profitable, you can do two things. You can increase your revenue, so drive more sales or do more stuff, whatever it is that you do. But likewise, the other thing you should be doing is cutting costs. And so why not be a remote worker in South Africa, where the cost of living is a third of what it is in Europe or Dubai or the UK? So that's what I mean by running your life like a business. Reduce your cost base, come back and live closer to family, but also maintain a primary currency income stream quite legally, and use that then to fund your lifestyle here. Let's move on then. So if you're moving back to South Africa or thinking about doing this, then one of the things you've got to do is make a choice about what you are in the world. So, are you an employee? Can you be an employee remotely? Is that even possible? We'll talk about that in a minute. Or are you an independent contractor? Are you contracting to that company or multiple companies at once? All those kind of things are often asked of potential clients. So let's look at the employee route. So you might have had a discussion and the employer saying, yeah, actually you could work remotely down in South Africa. Sure, why not? Let's have a look at that. So is staying on a UK payroll an option? What stops this and after how long? What about the pension benefits, etc.? Would anyone really know? These are the questions that we often get asked. So staying on the UK payroll, it is an option. However, quite often what I've seen this happen is that the payroll system is a UK system designed for UK individuals. So as soon as that is not an option anymore, quite often it's normally an overzealous member of the HR team that then sort of stops that arrangement for very, very good reason. Part of that is then linked into, for example, pension benefits. A lot of people aren't aware that legally speaking, the maximum that you can contribute to a UK pension if you're no longer a resident there is £3,600. So £300 a month is the maximum. So if you're contributing more than that, then effectively you might be getting a tax relief on funds that you're not entitled to. One other thing to think about is, are there other people like you working for that employer down in South Africa? Because that then starts to create labour issues here, which is what we'll talk about in a second. If you go down the independent contractor route, so this is where you've had the conversation where you can't really employ you overseas, sorry, we still like what you do, The first question is, will your company accept invoices for your services? And if that answer is yes, then actually you could potentially be a contractor. Do you also want to work for maybe more than one employer remotely and provide these sort of services on maybe an invoice basis? And potentially you might be paid in multiple currencies. So in that situation, being an independent contractor might make a lot more sense. So let's talk through these sort of options. Before we get onto that, let's talk about the dreaded revenue. So what your tax, who is it liable? Well, you have to pay tax to an authority. You can't pick a mix, okay? Physical presence down here in South Africa is the primary decider for non-South African citizens. So I'm talking to people that are born British like myself, or other foreign nationals. We move here. And what is it that they're looking for to determine that you're a South African tax resident? Well, are you in the country 91 days physically in the current year of assessment? So the tax year in South Africa runs from March to February. In that last year, were you here at least 91 days, about 3 months? Then have you been here at least 3 months a year, 91 days aggregate each year over the 5 years? And if not, again, that's not a tick in the box. And then over the last 5 years, have you been there in South Africa for at least 915 days of that time? Particularly if you were stuck here during COVID, that might be a yes. But you need to tick all of those boxes before you would then be deemed a South African tax resident. So that's very, very important. This is what we call a physical presence residency test. So as I said earlier on, this is the kind of thing we're going to see going forward in the UK. It's a 4-year window, not 5. So slightly different about no longer being UK tax resident with the changes that are being implemented over there. But still something that will hopefully clarify, whereas historically we were very concerned around, what does domicility mean, and trying to explain that to people is quite challenging, to say the least. One thing though, if you're a South African, by birth, South African citizen, you've been over in the UK for 20 odd years or whatever, you need to be also aware of this thing called ordinarily resident. So what trumps physical presence is if you are ordinarily resident. It's very woolly in the legislation. What it says is you need to be aware if you're returning to South Africa after your international wanderings. Okay, so let's say you're selling up in the UK, sold your house, get rid of the cash and what have you. It's all coming back down to South Africa, and your main residence is now here. Kids are going to school here. Well, then actually you might be South African tax resident sooner than you thought. Okay, and this is where I highly recommend bringing in a tax consultant so we can have an initial discussion, give you the sort of general principles free of charge. But ultimately, if you're not sure or it's not clear, actually a tax consultant is the only way that we would be able to pin that down so you know exactly where you are and when it becomes an issue in the future. So let's touch on now how to structure your employment or billing if you're working overseas, you're working cross-border. So one of the first things you could do is you could be employed on the payroll. So option A there, you stay in the UK, paid in pounds on a UK payroll system. Option B is you come and work for the South African subsidiary. They put you on the payroll and then you are employed. Very simple to understand. I think everyone gets how this works most places around the world. Obviously, I'm using UK and South Africa as the most common examples that we deal with. But your tax is normally calculated on what's called a pay-as-you-earn basis, PAYE. It's automatically deducted. You can sometimes try and claim expenses back depending on what it is that you do. Anything that's not employed, so property income, that sort of thing, you normally have to do an additional return for to cover that. And again, this kind of income is covered by the dual tax agreement. So you shouldn't have to pay tax twice in both jurisdictions. So if you go down the employed PAYE route, it's a relatively small risk of a liability building up. You shouldn't get into too much difficulties. I'll show you a bit of a gap in a minute between the two main countries that you might need to be aware of. But generally speaking, people that do this, as long as they can maintain it, don't end up with huge tax challenges. This dotted line, though, is where we start to move into the world of being self-employed or some kind of contractor. So this is a discussion with the employer saying, yeah, I'm not going to be an employee anymore. I'll send you an invoice for what I do. So you might do that personally. So you type out a little Word invoice and it comes from Mark McAllister trading as Mark McAllister, whatever. It's still you as an individual. It's personal, but you're contracting. So in that situation, the onus is on you now to go to an accountant or do it yourself, but you need to report to the relevant revenue service, what your income is, what your expenses are, etc. And then, pay tax on that. So where this normally goes wrong, I see clients that do this, but then don't allocate an amount to one side to pay the tax man. All of a sudden, they could do their calculation, and then at some point, there's a huge tax bill. So that's what I'm saying. It has a risk of significant liability. So it's important that you get yourself structured correctly. Again, any income that's deemed income, so paid, via invoice or whatever, is covered by a dual tax agreement. It gets a little bit more challenging if we're dealing with share schemes and all those kind of things. I'm trying to keep this very high level, but again, hopefully it makes sense. If you're in the more complicated discussion point, let's maybe talk about that offline. What people then often say, well, okay, Mark, yeah, I get where you're coming from. I'm going to just pop up a company and that's going to do my invoices. Okay, sure, makes a lot of sense, particularly if you're in the UK and you're staying there. A lot of people do this. So you can set up a UK limited company and generate invoices. Likewise, you can set up a South African company and generate invoices. Key difference now is the company is a separate legal entity. So when it raises an invoice to a client, what it has to do is pay tax based on its profit. So it's called corporation tax. If you want money out of it, you can have a salary, which is income taxable. But quite often people pay themselves a low salary and dividends. This is very common practice around the world. But again, there is a risk of a significant liability because you might think, actually, I'm doing quite well here. My income's really, really low. I'm taking all the dividends. But there is a slide I'll show in a second that shows why that's very challenging for somebody that's deemed a South African tax resident at the minute. So just be very aware of that. Your risk is quite high. You need to really do that only with advice from an appropriate tax consultant. Lastly, the offshore agency. I've touched on this before, becoming hugely popular in the digital nomad space and remote workers. Very, very simple solution that ties a lot of these issues up all in one go. Why? Well, because they can still pay you an income, like you're on PAYE, so kind of like option B there. You can choose to do that. Likewise, they can potentially pay you a market rate, and anything that's left over might potentially start to form the basis for future savings and investment vehicles. And there's really no risk of, or not as much a risk of liability as doing it within the company or personally. So if you're crossing that Rubicon into self-employed or contracting, that space, one of the things you might want to think about is an offshore agency an option. And again, we can talk you through those options and put you in touch with the providers. It's not for everyone, but it might potentially be for you, and we can try and help guide you through that process. One of the things that a lot of people aren't aware of is that when it comes to the dual tax agreement means that you won't pay tax twice between, say, the UK and South Africa, but they are very different systems. So, for example, in the UK, you're probably used to earning £12,570 tax-free. Okay, that's your personal allowance. And then up to the next £50,000 is 20%. That's what's called basic rate, and then it moves on through the additional rate and the higher rate. In South Africa, that doesn't exist. All right, you should be paying 18% on everything from 0 up to 237,000 rands, and that's what was last year, and it's also been confirmed for this year on the income tax tables. So one of the things to bear in mind that if you are, even if you're PAYE and do it through the UK side, you might be accruing potentially a tax bill here in South Africa. So even though you've done it right and paid tax to HMRC, so you haven't paid tax twice, you might potentially have something you owe to the South African side. And likewise, because the thresholds are quite low, you might be a higher rate taxpayer on a larger amount sooner than if you'd stayed in the UK. So again, this is something where I'd highly recommend getting a tax consultant involved. We can give you some guidance along these sort of lines and make sure that you aren't building up some kind of a liability. Where it really becomes quite a big problem is if you're a self-employed contractor and you're not provisioning for tax, in the appropriate jurisdiction that you are tax resident of. Like I say, you can see there at the higher rates, so 1.8 million rand, so I think it's about £80,000 at the moment, maybe a bit less, maybe £70,000. You know, you should be on a 45% tax rate on anything above that, plus a tax bill of 645,000 rand. So if you haven't got that to one side, then potentially you're going to end up needing to pay penalties and interest to the South African Revenue Service. So it's very, very important that you understand where you are before you carry on for too much longer. Okay, so link with that then. So coming back to the point about, oh, well, sorry, I'll pop a company up. That's the way to do it. And particularly with the UK, you know, so corporation tax there was 19%, it's risen to 25%. So there is this temptation, well, we can just keep the UK company going, it'll be fine. Oh, dividends tax there is a lot less, you know, it's only 7.5% or, you know, rising from there. South Africa's dividend tax rate is 20%. You know, I think I'll do the UK company, simple, it works, and all the rest of it. So we'll come back to that in a minute, why that's a bit of a danger. There are other jurisdictions that are more tax efficient. You know, so Mauritius is quite attractive depending on what kind of business you're doing. Isle of Man, very, very attractive depending on what type of business you're doing. But the key thing here is that when you come to structuring a company, don't forget as well what you're looking for is other things. You know, so is it a safe jurisdiction to be in? Is it easy to do business? You know, I talk to clients down here in South Africa that are beside themselves with the amount of red tape around things like exchange control and other regulations and what have you. It's not an easy country to do business in currently. You know, it might change as the government evolves down here, but it really is quite challenging. So that might be a primary reason that you're looking at restructuring what you're doing, but it shouldn't be focused on the fact you can save some tax. And I'll tell you why that is. So one of the issues that you've got is that if you're a South African tax resident and you've been here long enough, one of the things that can happen under a bit of legislation called place of effective management, so we call it POEM, or CFC, you can effectively be charged by the Revenue Service here, you know, the difference in the tax that you've saved by pulling the strings on that company abroad, and you would be liable for that personally, not the company. So again, if you think you're in that situation, I encourage you to chat to us, and then we can put you in touch with a tax consultant to scope out that risk. And where I most commonly see this, like I say, is people have an historic UK limited company, had it for years, used to the way it works. You know, why change it? They do a few years down here, they become either ordinarily resident because they're South African by birth, or they're a Brit and they become physically present over a period of time, and then boom, a few years go past, and then the demands start to land from SARS. So rather than leave it too late, it's best to talk about those things much sooner in the process and understand exactly where you are. So just popping up a company in a jurisdiction, on its own is not the answer in most cases. Again, my background was mergers and acquisitions. I used to buy and sell companies for a living. There's a lot of options on the company structuring side if you've got enough revenue coming through. So if you've got a big business, again, happily chat to us about how we can structure that, to make sure it's effective for your new life if you're here in South Africa, as an example. Last thing we're going to just touch on the agency and why it's so popular, the agency route, as I call it. So, we work with a number of providers on this front. Mauritius is one of the most flexible, I find, for the ex-UK. It's a very good jurisdiction. You can bill in pounds and dollars and euros and something like that. So effectively what happens is the agency will send your invoices for you to, say, your UK client. Fees will go back the other way for those invoices that you've sent, in the currency that you've requested, and then that sits in your agency. The agency will then pay you a salary, and that's obviously has to be market related. Anything that goes down that route is fully taxable at income tax rates, which we showed before. But what it does then create is the opportunity, if there's an excess that's left over, that the agency can start to contribute that into some kind of savings and investment vehicle, or it can issue a very tax efficient dividend into South Africa. But at the end of the day, what it allows you to do is really plan for your future effectively, and start to accumulate earnings in pounds, in dollars, in euros, away from South Africa, away from the South African government in a tax efficient format, which then allows you to carry on this process of living here in a very, very cost-effective way, but also keeping you flexible if you needed to decide that you wanted to move back to Europe, back to UK, or some other jurisdiction. We use this extensively for people that travel outside of the country. You know, there's a lot of what we call rotational workers. So if you spend more than 6 months out of the country, again, there's an exemption there where, you know, the first 1.25 million rand can be tax-free if you meet the requirements, and part of that is 183 days, of which 60 have to be in a row. And this is where this kind of solution really comes into its own. So if you're a rotational worker, if you're working on yachts, if you're working on oil rigs, if you're working on anything like that, this could be an option for you. Depends on your employer stroke, you know, the billing agency or entity we have to interact with. Happy to have a discussion about this. Very cost effective, certainly more cost effective structuring it this way than getting caught in the other issues that we touched on. So, but a specialist solution, best done in conjunction with a tax consultant. But again, let us talk you through the high level stuff and decide whether it might work for you or not. Last little bit, a note on UK pensions. Again, you've got a lot of UK South Africans that, you know, that are listening to this potentially. So workplace UK pensions should only be contributed to when you're physically present in the UK to achieve UK tax relief. So, you know, once you cross that line, you're back here. Legally speaking, the maximum you should put into them is £3,600 per annum. If you do try and put more in, it might work. So you might be able to do it. It doesn't mean that it's as it should be legally from a regulations perspective, from a taxation perspective. But normally what happens is that, you know, someone in HR eventually picks up on this, and that's often where we get brought in, is when that has been thrown up as an issue. One thing it does do, though, and I've talked about this before, is that if you have worked abroad and you've been physically present abroad for a foreign employer, blah, 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 and you come back, your income from your pension, your UK pension, could be a 0% income tax for life. So let's compare that with a retirement annuity or a living annuity in South Africa, where you pay income tax on those rand-based assets. Here it's completely exempt, and legally so. However, if you try and fudge the system and keep paying money into that UK-based pension, that component should really be taxable under the legislation. So just be really aware of that you might be muddying the waters and causing yourself a problem in the future. So again, happy to talk through that on a one-to-one basis if that helps. So then linking that all together then, so it's great if you're working cross-border, there's some opportunities to, you know, drive some more revenue, cut some costs, structure it effectively, you know, be mobile and nimble. But the message from me as well is, don't forget, the really important thing is that if you're earning this excess amount of money, plan for your future. If you take nothing away from today, please look at this. So one of the things that we work with is very flexible sort of foreign pension, foreign trust vehicles, you know, the ability to accumulate some money in pounds and dollars away from the country here. Potentially, you can start to draw that down South Africa in the future without any form of taxation, or potentially with, you know, minimal taxation. We can talk you through the legislation that's relevant there. The key thing as well is, with those structures, you've got a full range of global investments. You know, so you don't have to just buy rand-based investments. You can buy, you know, stocks wherever you want around the world if you have a particular interest in that. So if you're a digital nomad and you're a bit of an investor as well, well, talk to us and we might show you some things around how to carry on doing what you're doing, but in a slightly more tax efficient way. There's no restrictions on those kind of solutions. So, you know, again, coming back to the South African system, currently you can take 1/3 out tax-free, the other 2/3 has to go into an annuity, which is an insurance-based product. Not ideal, you know, you don't have a huge amount of flexibility, whereas, you know, the solutions that we offer, you know, fully flexible, you can take out as much as you want when you want with certain conditions. And the key question that gets you know, most people thinking about this is, you know, when I came here, the rand was 15.45. In 2010 it was about 10 to the pound. It's been up as high as 25 to the pound. It's now, I think, 23, 22. So is that trend going to change? You know, if you firmly believe it is, great, but let's be honest that it's probably going to stay about the same, you know, and if it does, well, then we're probably going to see 40 to the pound at some point in a decade or two, you know, so we have to plan for that depreciation of the rand. Other things that we assist with is primary currency investment property. So, you know, you might want to come and live here and live like a European retiree. European retirees have a lot of their assets abroad. They have investment properties, they have foreign pension vehicles, trust vehicles in primary currency, and that funds their lifestyle down here. Why not do the same thing? You know, it works very well for them. A lot of the really wealthy clients that I work with are European and UK expats, and property is a cornerstone to that investment strategy. So we can help you buy property abroad. We can help with mortgages. You know, don't think that you can't get a UK mortgage just because you're in South Africa. It is entirely possible. It's something we do all the time. But again, this has to be part of a financial plan so that we are, you know, coming up with a solution that's right for you in your circumstances, not just because, you know, it's the thing to do. Ladies and gentlemen, that's it from me. Hopefully that was worthwhile. We're going to go on to the Q&A session. So if you haven't already, please ask a question on the Q&A button at the bottom, or send me a WhatsApp, and I'll do my best to try and answer it whilst we're on the call. If you'd like to send me a WhatsApp, you can just scan this QR code now if you're watching this on a laptop, or just send it to the number that's on the screen now, and I'll do my best to try and answer it along the way. Right, let me just stop sharing that so I can see the questions as they're coming in. Right, here we go. All right, so here we go. I've got a question first of all here from Steve. So Steve is asking about the solution on cross-border working. So yeah, Steve, just to answer your question, yeah, it's entirely possible to raise invoices to various different clients in the UK. No different to if you were there being self-employed. With the agency route, you know, that's done via that point. And then, you know, the clients will pay those invoices. What I've found though is that there's normally a conversation that needs to be had with that employer, you know, about you becoming self-employed or going down the contracting route and moving abroad. You know, quite often the way I position that is, you know, are you you want to work with a jurisdiction that allows you to move around countries. You don't want to just be stuck with, say, South Africa, you know, if you move to another country in the future. And that's where Mauritius, being such a global hub and a really good quality jurisdiction, is something that, if it's positioned correctly, most employers will agree to that. But again, you know, feel free to reach out to us and we can have a conversation about that, you know, and introduce you to the providers if it's something interested in following. Okay. Here's a question again on WhatsApp from Lydia. Lydia, thank you very much. So it's just about the UK limited route. So yeah, so quite a common issue. So she's asking, you know, about dividends. So yes, just to be clear that if you're a South African resident and you're taking dividends out of a controlled foreign company, so something where you have a majority shareholding, you know, your dividends tax that you pay to SARS should be 20%. If you've paid a lower dividends tax to the UK government, you know, it doesn't mean that that's what you pay and that's it. It potentially means that the difference is due to SARS. So again, that situation is quite, you know, specific, quite complicated. Very, very important. I would recommend that you have a discussion with a tax consultant we can introduce you to, and just go through, you know, are you South African tax resident? You know, confirm that, either physically present or ordinarily resident. Let's get past that. Once you know that, how long for, and then what has potentially been underpaid can be calculated. It's always much better to you know, work it out and approach the revenue service, you know, when you've maybe made a genuine mistake through a lack of knowledge, rather than them catching up with you and then putting a demand on you after the fact. So that's one thing I would encourage you to think about. Okay, quick question here from Matthew. Can you just dive a bit into the 0% tax rate for UK pensions in South Africa? Do you mean the pension isn't taxed in the UK or South Africa? Okay, so I've done, there's another webinar you might want to look at, Matthew, that explains this in full. So one of the best things I feel about coming to South Africa, well, let's look at the list. You know, the hemisphere is the opposite to the UK. So if you want perpetual summer, you don't want to have a holiday home in Europe, you want it in the Southern Hemisphere. If you want to be in the same time zone as the UK, that's a line sort of either side down through Africa. And so obviously South Africa, with its cost of living, with the rand exchange rate, the fact everyone speaks English, becomes a front runner. On top of that, if you've accumulated a lot of UK pension assets, Once you get to access age, so currently that's 55, it's going to rise to 57 at some point in the future, then you can start to take income out of that. First thing you do normally is take a pension commencement lump sum. So that's a 25% tax-free amount, whether you're in the UK or in South Africa, it's tax-free. The 75% that's left over, you can do one of three things with. You can put it into an annuity. Not many people do that these days, but you can. Most people go into drawdown, so they sell a bit of their investments every year, get a bit of cash, and then pay that out to themselves as an income stream, so they're in control. And the third option is what we call, I would call it the Ferrari option, the full flexi drawdown. So you can take the whole thing out, and if you're in the UK, you pay income tax rates in the UK. So when you're in South Africa and you are confirmed as a South African tax resident, one of the things that we can then do is a little bit of work between SARS and HMRC. It's a bit of paperwork that we do with our tax consulting partners. And what they will do is then get a code in place that shows that no tax should be deducted on the PAYE system when they pay out from the UK pension provider. So you take £20,000 worth of income, rather than going, oh, that's over the £12,570 limit, we need to pay 20% on the bit up to £20,000. They will just pay you £20,000 with no tax deducted. It's then your responsibility to then declare that in the country that you're operating in. In South Africa, and this is the key point, that that income is then exempt from income tax. So it's not tax-free as such. It's just that since 1962, South Africa have created an income tax schedule which includes an exemption. That's section 10(1) GC-2 of the Income Tax Act. So when you draw that foreign pension income, as long as it meets the criteria under that subsection of the law, then you also don't pay income tax at all in South Africa. What does this then lead on to? So firstly, great, you can come down here, lower cost of living and less tax. That's why so many people are moving down here and why we have so many new clients that have been joining, particularly post-COVID. I think that's made a lot of people really question why be in the UK. And then this budget that just happened a week or so ago, the other problem that you've got is if you've got assets in the UK north of £325,000 as an individual, or £650,000 a couple, those could be subject to inheritance tax from 2027. That includes your UK pension pot. So you've done all of this work, you've been a responsible saver, you've got a few £100,000 in pension pot, you come down to South Africa and you're living off it tax-free, and then you unfortunately pass away unexpectedly. That UK asset could be subject to inheritance tax. So one of the things that we're now looking at is if you're over the age of 55, maybe it makes sense to start to take more of that out through that tax-free route that I've described, and instead structure it in a slightly different way. And then that might also reduce your UK inheritance tax bill and your South African estate duty bill quite effectively, really. So hopefully, I know that's quite a lot to take in, Matthew, but hopefully it answers your question. So whether you do it with us, whether you do it yourself, or whether you do it with others, the main thing is take advantage of it. We'll happily talk you through, in your circumstances, what we would be doing or thinking about. So our consultations are free of charge, and then most clients look to work with us purely because we're so cost effective and experienced in that specific area. But the choice is yours. Hopefully, it answers your question. Moving on, Cheryl, do you offer advice for people here with similar assets, pensions in different countries other than the UK? Yes, absolutely. I have clients from all over the world. So in my Getting Financially Fit to Return webinar, we talk about some of those other countries. So like Europe, like America, like Australia, New Zealand, it's actually some really great options there. So no matter where you have been and, or you were born and now you are coming to South Africa, it does make sense to have a discussion with us, and we can then sort of give you, the benefit of our experience having dealt with similar people to yourselves, and show you the difference, that if you leave it as is, what's your risk, where are you going to be subject to taxation and other things. And then if you plan effectively, quite often there's a significant reduction in tax bill on those assets, no matter where they are in the world. So Cheryl, hopefully that answers your question. If we can assist in any way, please do, don't hesitate to reach out. I'm just going to share our contact details again as we sort of start to wrap up. So again, if any of that resonates with you, if you're looking to explore this a bit more and understand how it all works, then just drop me an email or a WhatsApp, and you can just scan this QR code that's popping up now. And that'll link you straight through to me and the team, and we'll do our best to respond. Again, just want to be clear, we don't charge for our time, so if you want to come and see us, we won't charge you an hourly fee or a consultation fee. It's completely free to be open-minded. They're complimentary. But one of the things that we'll be looking to do is assist you with a solution at some point if it's appropriate, and that's ultimately when we will be remunerated if we go down that route. So yeah, it costs nothing to be open-minded is my message there. Okay, ladies and gentlemen, if there's no more question, yep, Matthew, last little one. It will be posted on YouTube. It's also going to be on my Facebook page. So if you want to, please follow us. Let me just see if I can find that very quickly. I should have done a shameless plug for that while I was here as well. Yes, the Facebook page. If you like this content, if you want to learn more, follow us. It's on Facebook, the UK Expat IFA. So independent financial advisor for UK expats is what that kind of means. Please leave us a review if it's been worthwhile. Like I say, we do this free of charge to help increase people's knowledge and awareness. If you want to do business with us, fantastic. But at the end of the day, I just want people to be more informed and aware of the opportunities, particularly that South Africa has to offer, and how you can navigate everything. So Matthew, hopefully that helps as well. Ladies and gentlemen, I'm going to wrap it up there at the 40-minute mark. I did promise to try and keep it short and sweet. Thanks very much for your time. I hope it's been worthwhile. If I don't speak to you soon, all the best and take care.